Thank you for taking a look at Worth Unlimited and the innovative online banking system known as the Worth account. The best way to describe the Worth account is to compare it to a GPS or navigation system for a car. You get in your car, you type in exactly where you want to go, and it maps out how to get there. And of course, if along the way you make a wrong turn or you miss an exit, what's it do? It recalculates and it guides you how to get back on track. Well, let me ask you, do you think it'd be valuable to have a tool that did that exact same thing for you, but financially? That's exactly what the Worth account does. It looks at your entire financial location today and guides you mathematically the fastest way to zero. And it doesn't just show you the way and send you off by yourself. It follows you. It recalculates with every single transaction, so you always know exactly where you're at. Our average client pays a 30-year mortgage off in 8 to 12 years and a 15-year mortgage off in 7 to 8 years. It also pays off credit card debt, student loans, hospital bills, any revolving debt. We'll start off by giving you a little background on our company. We started as a mortgage company in the late 90s. We're very successful in that industry. But early on in business, we started to see a lot of repeat customers. And in most industries, that's a good thing, repeat business. But in the mortgage industry, when somebody's coming back to refinance their home every other year or every third year, it's usually not because they're in a good situation, but because they've accumulated what? More debt. And they have to use the equity in their home to keep their head above water. And of course, that goal of actually getting their home paid off gets further and further away until it becomes non-existent. The first version of our program came out in 2004. We didn't just throw it out to the country and start selling it. We did a beta test in Denver, Colorado with 400 homeowners. We wanted to test it against every type of income, every type of budget, every spending habit. And after a 2-year test run, the average client was 20% ahead of their projected payoff. Because as you'll start to see, the program starts to instill a discipline in you, and it's almost an unconscious discipline. You'll see what I mean by that. Today, we're just excited. We have just under 100,000 clients across the country using our program to ultimately achieve that debt-free lifestyle. In 2008, we caught the eye of Ernst & Young, one of the largest financial service firms in the world. Every year they give out an Entrepreneur of the Year award, and it's a pretty big deal just to be nominated for the Ernst & Young Entrepreneur of the Year. Wells Fargo Bank actually nominated our company, and we walked away that evening with the award. So we joined the ranks of companies like eBay, Apple, Microsoft, who have also won the Ernst & Young Entrepreneur of the Year. Well, let's jump right into this. How does it work? That's the main question we ask when we show someone that their debt can be paid off in 8, 10, 12 years, credit cards, student loans, hospital bills, mortgages, everything. That's the first question. How? Show me the nuts and bolts. Well, we focus on 3 things. First is mortgage payoff. Second is paying off all the other debt in mathematically the fastest order. And the third thing is provide coaching and education and accountability along the way. Let's start off talking about mortgages. I think most people, when they take out a home loan, they don't know a whole heck of a lot about it. They might understand the monthly payment and they might know the interest rate, but that's about it. So I'm going to give you about a 30-second mortgage basics class. Let's take a $200,000 mortgage at a 6% interest rate. Over 30 years, which is 360 months, the payment is $1199.10. That's the actual payment for those terms. Month 1, we send in $1199. Only $199 of our payment actually goes to principal. $1,000 goes to interest. Month 2, $200 of our payment goes to principal, $999 to interest. So we just increased the principal portion of our house payment by $1. We're really pounding down that mortgage, right? After 1 year, we've made $14,000 in house payments to only retain $2,400. In other words, only $2,400 of what we've paid in went to principal. After 5 years and $71,000 in payments out of our pocket, we've paid $13,000 down on the principal. Year 10, $143,000 in payments to actually get to keep $32,000. Think of any other investment in your life. If you knew going in, which we do with a mortgage, that you would have paid $143,000 in 10 years and only have $32,000 to show for it, would you do it? Probably not, right? Now, don't get me wrong, there's plenty of advantages to home ownership, but the mortgage is not one of them. We need to get it paid off. It's a liability. You know, some people think after the 15th year on a 30-year mortgage, they're what? Halfway done? Well, it's actually year 21. We've made $300,000 in house payments, so we've paid for the house 1.5 times over, and guess how much we still owe? $100,000. We just hit halfway. It's not till the last 10 years of the loan that we actually have more of our house payment going to principal on a monthly basis than to interest. And of course, if we take that loan to term and pay all 30 years, we would pay back $431,677 on a $200,000 mortgage. That's more money in interest than we even borrowed in the beginning. Now let's talk about how mortgage acceleration works. I'm going to show you a hypothetical situation. So let's just pretend, work with me here, pretend that we could afford to add $5,000 to the first monthly payment. Not every month, just one time. So we sent in $61.99. Let's see how that affects the loan. We get our statement in the mail the next month and we now owe $195,000. So it worked. Right, it knocked $5,000 off the principal. Our house payment and interest rate both stayed the same. They didn't change, but check this out. We were scheduled to pay for 360 months. That one $5,000 principal contribution just canceled 23 months or 2 years payments off our mortgage. The interest we were scheduled to pay was $231,000, but again, that one $5,000 principal payment just canceled $28,304 of interest off the loan. Even if we don't count the $5,000 we sent in, that's a net savings of $23,304. Guaranteed. The second that $5,000 hit the mortgage, it canceled 2 years house payments and $23,000 in interest. Now, folks, this is not the worth account, but this is the system we use. I just wanted to show you how a lump sum payment affects not only the time we pay on the home, but also the amount of interest we're going to pay. So do me a favor, put this example in the back of your mind. I'm going to refer back to it here in just a couple minutes. Now, when our program first came out, it actually required that you had a home equity line of credit as a second mortgage. And that was okay back in 05, 06, 07 because everybody could qualify for home equity lines back then. But what's it like today? Hardly anybody, right? It's getting better, but it's still very difficult to qualify for. So we've had to redevelop and upgrade the software to the point where it is today, and you don't need not only a home equity line, you don't need any type of credit line. To be able to qualify to use the worth account, all you need to be able to get is a checking and a savings account. You can even stay at your current bank. Now, folks, I don't expect you over the next 12 to 15 minutes to walk away from this video understanding every algorithm and interest cancellation aspect of the software, but I do want you to walk away with the concept of how this works. And the easiest way for me to explain the concept is to show you how it used to work using a line of credit. So I'll show you how it worked using a line of credit, and then I'll show you at the end how it works today using a checking and a savings account. So let's take that same $200,000 mortgage at a 6% interest rate, and let's say we could qualify for a $10,000 line of credit. Okay. The first thing we're going to do with this line of credit that you have to understand is we're going to use it as our primary checking account. So we're going to pay all of our bills from it, our house payment, car payment, cell phone, groceries, utilities, entertainment, insurance. So as we do that, the balance goes up. But as soon as we get a paycheck, we deposit it into the line of credit, which is our new checking account, and the balance goes down. Every time the balance on that line of credit gets down close to zero, the worth account program kicks in and prompts us to do what's called a funds transfer. A funds transfer basically is saying take a sum of money from the line of credit and send it over to the mortgage. In this example, it's prompting us to do a funds transfer of $5,000. We hop online or we write a check from the line of credit and send it over to the mortgage. Now think back. What does $5,000 do to a $200,000 mortgage at 6%? We just canceled 2 years' house payments and $23,000 in interest instantly. Now again, when I saw this the first time, I said, hey, yeah, that's great, but you still owe $5,000 on your line of credit. All you did was create one debt to pay off another. Okay? When we run your analysis and show you that your home's paid off in 8, 9, 10 years, not only is the first mortgage paid off, so is the line of credit. Now, how does the line of credit get paid down? Because remember, we're using this as our primary checking account. So as soon as we get a paycheck, what do we do with it? We put it into the line of credit. Now, in real life, because we're paying bills out of this as well, it might take us 2 or 3 months to get that line of credit paid down close to zero. But as soon as it gets close to zero, what happens? It does it again. And it continues to repeat that process until we're completely paid off. So what I want to do is I want to take a sample family and we'll just run through a few months of their life, and this will really help you grasp the concept of how the worth account works. Let's take our sample family and say we make $5,000 a month in income and have $4,000 a month in bills and expenses. So that's everything. That's our house payment and groceries, everything included. That leaves us $1,000 of discretionary income. Okay, again, this is just our sample numbers. The program works even if you had $10 a month of discretionary income. So we're going to show an account register on the line of credit. Month one, the first thing we're going to purchase out of our new checking account, which is our line of credit, is the actual worth account program. Now, folks, for years, it didn't matter how much interest we saved you or how much debt you had. The cost of the program was the same for everyone. It was a one-time upfront charge of $3,500. Okay, I don't know about you, but the first time I saw that, I said, man, that better be some good software. Then I had my own analysis run, and it took my 28-year mortgage down to 5.7 years, and it saved me $180,000 in interest. Now, I really started to look at that, and I thought, you know what, I actually paid more than that in closing costs to get into debt. But the cost of the program today actually is not $3,500. It's variable depending on how much interest we save you. So when we run your analysis, we plug in your mortgage, your credit cards, your vehicles, your student loans, the percentages. The software actually calculates how much interest will be saved given your situation. And the cost of the software adjusts accordingly, anywhere between $750 up to $3,495. So we're going to say for this example, back to our sample family, that they paid the max, $3,495. We'll call it $3,500. But they also have to pay bills, monthly expenses. $4,000 goes out, right? So now they owe $7,500 on their line of credit. But they deposit their paycheck in there, and the balance goes down to $2,500. I'm going to say we're at a 10% interest rate. Even though interest rates on lines of credit today are more like 3 to 4%, we're going to say we're at 10. The finance charge for the month would be $20.83. The $2,500 balance gets carried over to month 2, and we spend $4,000 in monthly expenses. We just continue living our life as normal, deposit our paycheck like normal. The line of credit's down to $1,500. At 10%, $12.50 is our finance charge for the month. So look at the line of credit. $3,500, $2,500, $1,500. It's getting paid down. Month 3, we deposit or spend $4,000, deposit $5,000. The line of credit's down to $500. We're almost down to zero. What's getting ready to happen? The worth account program kicks in and prompts us to do a funds transfer. It tells us the exact amount to move. We send that over to the mortgage. The line of credit goes back up. At 10%, it costs us $34 that month. So, folks, we've been on the program for 3 months. It's cost us $68 in interest on the line of credit on over a 3-month time frame. But let me ask you a question. When we pulled that $36.75 out of the credit line and we sent it over to the mortgage, what part of the mortgage did it go? The entire thing went to principal because we'd already made the house payment and canceled or paid all the interest for the month. And on a $200,000 mortgage at 6%, We just canceled $17,249 of scheduled interest off the loan, which is 18 house payments gone that we'll never have to make. If we look at the amortization schedule again, we're down to 339 months. 3 months ago, we were at 360. The principal portion of the house payment just increased $19 in 1 month. We were increasing it $1 a month. Do you realize it would have taken you a year and a half of making your house payments to accomplish what we did in a 3-month time frame? And we owe $195,700 on the loan. Now remember the line of credit. Jump back to month 4, it was up to $4,100. We just continue living our life as normal. Nothing changes. $4,000 out, $5,000 in. The line of credit's down to $3,000. Month 5, $4,000 in expenses, $5,000 in income. It's down to $2,000. Here's what we're getting charged by the bank on our line of credit. So month 6, spending $4, depositing $5, the line of credit is back down to $1,000. We're almost down to zero. What's getting ready to happen? Another funds transfer. This time it tells us to move $2,920.23. Let me ask you a question. Does it make you guess how much to move? No, it tells you to the penny for your situation. That's the thing that separates us from almost every other program on the market today. The program calculates to the penny the most effective number for you. Because your expenses and income constantly change, that number will change for you as well. But it's completely customized for you. So again, in month 6, we send that right over to the mortgage. The entire thing goes right to principal, and we cancel another $12,200 in interest off the loan, which is 16 more months. So wrapping up 6 months, folks, 6 months look back. We've had $146 in interest paid on the line of credit over a 6-month time frame to cancel $29,500 in interest off our mortgage, which is 37 house payments. What's amazing about this is you have to realize if you're a homeowner, you're already on the hook for this $29,000. I have people look at our program, and if it might cost them $1,000 or $2,000 or $3,000 to get started, in 6 months we've canceled $29,000. And they don't realize that $29,000 is money that they are currently scheduled to pay. Okay, if we look at the amortization schedule, we're down to 323 months left. The principal portion of the house payment increased $15 more in 1 month, and we owe $192,000 on the loan. So we've paid down over almost $8,000 principal in 6 months. So folks, hopefully you're starting to grasp the concept. I'm going to go ahead, just for sake of time, I'm going to jump to the end of the year. As you can see in month 9, another funds transfer kicked in. Before I get to month 12, let me point one thing out. I realize we're making this look good on paper because we're keeping our expenses and income the same, right? Does that ever happen in real life? Of course not. Income might stay the same, but expenses change. That's the beauty of the program. It recalculates with every single transaction and adjusts accordingly. So chances are in month 12 we were going to do a funds transfer, right? Because the line of credit was going to be paid down. What if we overspent? Let's say we made $5,000 but spent $6,000. The program recalculates. You know what? We might actually still do the funds transfer next month. It's just going to be a smaller amount. But it tells us to the penny for our situation. So here we are in month 12. Back to our same numbers. We know what's coming, right? Again, no guesswork. It tells you the day to do it and to the penny how much to move for your situation. So we take that funds transfer, we send it right over to the mortgage, and in month 12 we cancel $10,000 more interest off our loan, which is 14 more months gone. So guys, wrapping up 1 year, we've paid $297 in interest on the line of credit over the course of a year to cancel $50,800 in interest off the mortgage, which is 53 house payments. Folks, you realize even if we stop using the program today, we've been on it 12 months, those 53 payments are gone. They never come back. rather than increasing our principal payment by $1, so at the end of the month we have, or excuse me, the end of the year we have $12 more going to principal. We have almost $76 more going to principal now with each house payment. So just an incredible difference. And we owe $184,000 on the loan. So we've paid down the principal of the mortgage over $15,000 in 1 year. If you had just been making your house payment, which is what most people do, you'd still owe $197,500 on the loan. It would take you 5.5 years to accomplish what we were able to accomplish in 1 year using the Worth account. The payoff on this example is 10.4 years versus 30, and the savings is $161,000 in interest. Now, folks, I've been doing this for a long time, almost 8 years now, and it always amazed me that people, when they saw this big number, they didn't just have to pick their jaw up off the ground. If you get anything out of this presentation today, I want you to understand that this $160,000 is actual cash. That's real money that you currently are scheduled to pay on your mortgage and on your debt, and now you don't have to. Think for a second how your life would be if you had no debt. If your home was paid off, your cars were free and clear, you had credit cards but they had zero balances on them. Would you sleep better at night? How many of you have ever lost sleep or stayed up late because you were stressed financially? Would you have a better relationship with your spouse and your family? How about at work? Would you be more effective at work? Have less sick days if you weren't stressed financially? What would you be able to do charity-wise? The people that you would be able to help out, would you donate more to your church or to your charity? What kind of vacations would you take if you had no debt? Well, let me point something out to you. You are paying for that lifestyle right now. You're paying for those vacations. You're paying for that stress-free lifestyle. Those charity donations, you're making them. You're just making them for somebody else. You're paying for that lifestyle right now for somebody else, because that $160,000 is real money, and it's either going to leave your account or it's going to stay in it. Now here's a snapshot of the actual software program. Across the top, this is the online banking system. For my wife and I, this is the most addicting window to the entire thing, your payoff. And the reason it's so addicting is because this number is constantly changing. It recalculates with every single transaction. So not only does it go down with time, if you got a raise in pay, you got an income tax return, you changed an expense like a cell phone, something like that, that number goes down months and months overnight. Okay, it can go the other way as well. If you take money out and spend it on something else that's not already in the system. One thing you can do too, gives you 20/20 financial foresight. You can log in, tell it about an expense or a change in pay, and it'll tell you how that will affect you before you actually do it. Okay. A couple of these, and I'll put all these up here so you can take a look at them, but live transaction updates. The program can link right up with your accounts. If you go to the grocery store and swipe $50 on your credit or debit card, by that night it shows up executed in your program. It tracks every cent. No more getting to the end of the month or the end of the year and looking back saying, wow, where did it go? We understand how it works on a mortgage. What about other debt? Right? Because doesn't the average American situation look a little more like this? And every debt guru has their system of paying this down. One person will say, pay the lowest balance first. The next person will say, no, pay the highest interest rate first. Well, who's right? Look, they're both good because they at least get you doing something, but they just cannot keep up with the math that the program can do, because the program has the ability to take every aspect of each debt, balance, length of debt, meaning is it a 5-year, 10-year, 20, 30-year loan? What's the interest rate? How's the minimum monthly payment calculated? When's it due? How can we free up the most money each month? And of course, if the rate adjusts, what's the program do? It recalculates as well. So it takes all that information into account and lines up your debts mathematically the most beneficial way to pay them off. So, folks, I'll kind of end with this and wrap it up. I mentioned in the beginning you don't need a line of credit. I just showed the line of credit method to help you grasp the concept. So, basically, here's how it works. We use the line of credit as our checking account. We just paid bills, so the balance is up. Our income comes in. We roll it into the line of credit, and the balance goes down. Next month, same thing. We get paid. We put it into our new checking account. The balance goes down. It took us a couple months, but the line of credit finally got paid down low enough. What's getting ready to happen? A funds transfer. Again, it tells us the day to do it, the exact amount to move, and to which debt to do the funds transfer. In this case, we have more debts than the mortgage. So in the beginning, the funds transfers may not go to the mortgage. They're going to go to whatever debt is mathematically the most beneficial. In this case, it's the motorcycle. Well, 2 or 3 more funds transfers and that motorcycle is what? Paid off. And it frees up that monthly payment, and then it starts working on the mortgage or the car, whatever's mathematically the most beneficial. Now, I mentioned in the beginning, you do not need a line of credit. Don't call the person up who sent you this video and say, now where do I get that line of credit he was talking about? Because you don't need it. About 98% of our clients today are following the program just using their checking and savings account. The first thing you do is come in and tell the program how much you always want in there. What is your safety net? And it will never have you move below that amount. And you can always change it. So here's how it works. Income comes into checking. We pay bills. Now, since we don't have a line of credit, we have to pay with our own money, right? We might use a credit card and then pay it off at the end of the month. But ultimately, the money's coming out of our checking account. Whatever's left over, to the penny, gets kicked into savings. Next month, same thing. Income comes into checking. We pay bills. Whatever's left over at the end of the month gets kicked into savings. Now look at this. Think back. With the line of credit, the discretionary income was paying down the balance. With the savings account, the discretionary income is building a balance. So in the same amount of time it would have taken us to pay down a line of credit, we built up enough money to do what? The exact same funds transfer. Again, it tells us the day to do it, the exact amount to move, and to which debt to do the funds transfer to. You know, we talk to people almost every day that say, well, you know, I'm sending some extra money in on a credit card. I had an extra 100 here, and I make an extra house payment a year. Look, it's good that you've been sending in extra money, but basically you're forcing your discretionary income towards potentially the wrong debt. You're going to want to stop doing that and let the program tell you where to send that extra money. You're going to pay off probably less than half the time by trying to do it on your own. Folks, if you're seeing this for the first time, get with the person who sent you this video and tell them you want to have your analysis run. It's totally free. It's no obligation. And it's not only is it confidential, but you're not giving any information other than balances, interest rates, and payments. We don't take any account numbers, no social security numbers, anything like that. Basically what it is you're just taking a snapshot of your starting location for the Worth account. And it will tell you exactly how much time it'll save you, so when everything would be paid off, and how much interest gets to stay in your pocket as opposed to going to the bank. Do not procrastinate. It's very easy to put this on the back burner. Get your analysis run today, and then you can make a decision whether it fits into your financial goals or not. Thanks a lot for your time, and again, hopefully you found this information beneficial.